Hi, everybody. Welcome to Friday morning. We're off and running. The market's open, and it's time for uh, another live stream of Rebel Income. And so I'm looking forward to our discussion today. And we have, as always, there's plenty to talk about. The market's moving, and we have some open positions to evaluate, and we'll probably have some time as we get things rolling to look at some stocks that the rest of you have some interest in as well. Let's go ahead and start here really quickly for those of you who may perhaps not be familiar with Rebel Income and what this is about. Since this is a public live stream, and we may have some people coming on and watching it later. Rebel Income is an income generation investing system. Focuses on income generation by emphasizing fundamental and value-based analysis to identify stocks that are trading at reasonable levels relative to the value of their business. And then the income generation part of this comes by using options to create that income source by being the seller of these options. Most people, when they think about options trading, they think exclusively in buying terms. If I think a stock is going to go up, I'm going to buy the stock. Or I'm going to buy a call option. If I think it's going to go down, I'm going to buy a put option. Buying strategies, when it comes to the options market, tend to be very, very low, have a very low probability of success. On the other hand, if you take the opposite tack, you decide to be the seller instead of the buyer, we're effectively flipping that script. And instead of accepting the low probability of success on the buyer side, we're taking the opposite side. So we're increasing the probability of success on our end, being the seller. So that does change some of the mechanics of the trade. It certainly changes some of the considerations that go into that process. And so that's kind of the reason for what we talk about in this live stream, is to look at the different trades that we've been placing and what's going on in the market in real time, so that we can decide how those things impact each one of these positions from the standpoint of not only income generation, but how that impacts possibility of owning the stock. Anytime you become a seller of options, you are giving somebody else the right to exercise the option for you. And what that means is, in the example of a put option, you're giving somebody else the right to sell you the stock at a given price. Now, that is only going to happen if the stock has dropped below the price that you have sold. We do some things to try to manage that likelihood, not necessarily to minimize it, because we are focusing on stocks that represent effective values, and these are stocks that, for my part, I would consider useful parts of an overall long-term growth portfolio. So we don't necessarily shy away from those, but those are called put assignments. Those are called assignments, when somebody exercises the right to sell you the stock at that strike price. You're being assigned the stock. If you own the stock, and another way that you can generate income is by selling calls against that stock, and so that's called a cover call. We do those pretty frequently as well. And again, what you're selling somebody is the right to buy that stock from you at the strike price that you sold. That only happens if the stock has moved above that strike price. And so again, there are strategies to try to manage not only that likelihood, but also to consider what the price you're selling is relative to the price that you bought the stock at. So all of those go into the decision-making process, and are some of the things that we want to evaluate and kind of try to get a temperature for on a regular basis. I go through this process of evaluating these trades each week in the live stream, so I can show you in practical terms what a little bit of the review process should be each day if you're placing and managing these same trades. So let's go ahead and dive straight into it, and that's enough of the groundwork, I guess. If there are questions that come up as we are going through some of the things that we're going to be talking about today, please feel free to use the chat. I'm going to be paying attention to that throughout the course of the session. I love seeing questions and comments and trying to enhance the live stream with your participation. So thank you. I appreciate those who are here and the participation you always give. All right. I am on a Google sheet that I keep, which is the track record that I've been following for Rebel Income for the past 11 and a half years. And so this has tracked all of the trades that I've placed in that time. You can see there's really only a few open trades right now, and one that is set for expiry today. So that's where we're going to start our review process, and we're going to start talking about what's happening, and then we'll move on in and we'll talk about CTRA and this week's trade on Nike. So let's start here. We're talking about Bristol Myers Squibb, stock symbol BMI. This is a trade that I placed on the 10th, so 2 weeks ago, just a little bit over that, selling the $46 strike price and bringing in about 1.63% for that 16-day trade. Now, one of the things that's worth pointing out here is the math that is involved. If you look at the return that I have in the numbers I have in each of these return numbers, you see the vast majority are very conservative, talking about 1 to 2%. Sometimes there's a 3%er in there, but pretty rarely. It's usually somewhere between 1.5% and 2% for most of these. These are very when we become the seller of options. The emphasis here is on trying to manage the overall, trying to manage the position, manage risk. Part of that means selling less time rather than more. Options have, of course, a time decay element that you have to think about. Time decay works against buyers categorically. If you have bought options at all, you've seen this happen in real time. On the other hand, for sellers, time decay is an asset. This is something that gives us an advantage and that we can leverage. And so my basic rule when it comes to time duration on my trades is to sell no more than a month. And if I can sell less time, then that is usually the preference. So you can see, for example, last week on CTRA, I sold 1 month of time. For Nike, I was able to sell only 9 days. So that one expires next week. And for Bristol Myers, I sold 2 weeks. So again, we're working with short-term trades, and I want to demonstrate how to put the return numbers in a practical context. Now, this is idealized, it's simplified, but the math I'm going to show you is pretty simple, and it does give you a pretty good way to start thinking about what kind of real numbers the kinds of trades we're placing really provide. Hello, Jay. Welcome. So glad that you're here. So glad everybody that is here so far is. And again, hopefully we'll get a few more coming in. If just one last, sorry, I'm going to diverge just for one moment. In the interest of trying to see this live stream grow and Rebel Income grow as well, please do share share the links to these live streams with your friends. If there are people that you know who are interested in investing and specifically looking for ways to try to generate income, or simply want to think about a different way of looking at the market than what they're probably used to, please share this with them. Invite them to come and participate, and let's try to. I want to try to grow our community as much as possible, and I think this live stream is a good way to do it. Okay. So with Bristol Myers selling the $46 strike price, this creates an obligation for me potentially of having to buy the stock at $46. That means that in order to secure the trade, I need to multiply. I need to make sure that I have enough cash in my account, excuse me. Need to make sure I have enough cash in my account to cover that potential obligation. You need to have that either in cash or in margin plus cash, combination of the two. If we're working in a retirement account, and it's going to be exclusively cash. A more conservative approach, in my preference, is to work exclusively on a cash secured basis and not to use margin. So the math here is pretty simple. I sold one contract. One contract is equivalent to 100 shares. So if I multiply 46 by 100, then I then I have an idea of exactly what my capital reserve requirement is, $4,600. That has to remain in place for the duration of the trade. Now, so that 46, again, that acts as that reference point. Now, I can also use that as the reference point. Well, let me back up here. In terms of trying to think about the return numbers in a larger context, we need to look at the duration. The duration of this trade was 16 days. I placed this a little over 2 weeks ago on a Wednesday. So when you divide 365 days, which are obviously 1 year, by 16, we get 22.8. I'm going to round down. I'm going to try to be more conservative. That gives me possibly as many as 22 trades. If I were to repeat this trading process, whether it's the same stock or not, or to repeat this every 16 days, that would give me, with the same $4,600 I just referred to, this would give me about 22 trades over the course of a year. Now, if I can replicate the 1.63% that I brought in on Bristol Myers every 16 days, the question is, what does that aggregate to? Again, this is simplified math. These numbers aren't always going to be available in the same way. Sometimes you're going to be working with different time frames. Sometimes the return numbers are just going to be different. But I'm going to multiply 1.63 by 22, and that gives me 35.86% on an annualized basis. That's actually really attractive, and that's one of the reasons that I love making these very short-term trades and just bringing in 1.5% or whatever that number ends up being for that time period. This is literally picking up the low-hanging fruit of the market. Very few, the majority of retail traders, frankly, just don't even think about these trades because they just don't look that impressive by themselves. 1%, 1.5%, so what? But it's the aggregate of these. It's the net compounding effect that you achieve over time that really gives you the long-term result that we're going for. So Bristol Myers, then, this is what the overall setup was. The question now, since we are at expiration, is, am I looking at a possible assignment today? Or is the stock in a position where this option is likely to expire worthless? So we'll go ahead and pull up the chart for Bristol Myers. And stock is clearly below at 46, a little bit above 43. And we can see bearish momentum has really been picking up for the past few weeks. Had peaked a little bit below $48, I should say. Again, I sold the $46 strike price. So here's my assignment level, roughly. And so we're clearly below that point. So this does look like I'm going to be taking an assignment. Okay. So the question here at this point is that a problem? We're looking at the day of. The stock is a little over $2.50 below the strike price that I sold. And so I want to get your thoughts on this. Is this something to be afraid of? Jay says, not a problem. I'm going to qualify that a little bit, but in the broadest sense, I agree. This is not one of the things you have to be careful about. Jay, I got assigned last week and already sold a call for 25 cents expiring today. So Jay, you've already got the income generation, excuse me, the income generation cranking on this, which is awesome. Jay gets a mark, which is great. Whenever I place these trades, if you are a subscriber to Rebel Income, you're receiving my trading alerts. You'll notice that I explicitly always try to say that I am willing to buy the stock at the strike price that I'm selling. I believe really, really strongly that when you start working the sell side of these trades, you need to think very, very practically about what the possible ramifications are. That's why I say that I will never sell a put option on a stock I'm not willing to own. I treat put selling very much as a gateway to stock ownership, as a way to build an overall portfolio. So I do look at this as an opportunity to acquire stocks that I like. That's one of the reasons why Jay's statement, not a problem, I absolutely agree with. I'm not afraid of taking these assignments. The caveat to that is not that you need to decide for yourself in some abstract form that you're willing to accept that. You need to also think about it in very practical terms. The stock is a little over $2.50 below my $46 strike price right now. That means that I'm going to take an assignment and I will immediately be down on paper anyway. This is just a paper loss, as it were. But I'm going to be down $250 on my 100 shares. That is a net loss. Now, that's not a huge loss at this point, but it is below the strike price that I sold. The stock is picking up bearish momentum. I do expect to see the stock stabilize somewhere around its current price. We've got this really strong pivot low all the way back at the beginning of August at around the same level. And it does seem to be, at least for now, it does seem to be trying to push a little bit higher, even though the day's momentum doesn't really show that. We are a little bit up now so far today. But so it does look like we're starting to see some support here, which is nice. But the truth is, over the last few weeks, the momentum here is clearly more bearish than bullish. That's why I'm going to have to take this assignment. So you have to think about that in practical terms. Is already being down $250 on this position per contract, is this going to create a problem for you? If you're selling so many contracts that this is something that would create some stress, then you need to reevaluate your trading rules a little bit. And the first one that you need to focus on is position sizing. I'm going to go back to my track record here for a minute. We'll take a look at the option chain a little bit as here in a minute as well. But first, I want to try. I'm going to beat the position sizing drum here for just a minute, because this $46 strike price, again, this is why this is really, really important. It's not just the amount of money that I need to keep in reserve. See, this is going to be an expense for me after the market closes today, because I'm going to let this option expire. I'm going to accept this assignment, all things being equal. That means I'm going to immediately go in and I'll be in the hole. If the stock doesn't stabilize at all from its current price, I'm going to be down about $250. Again, that's not a realized loss, but I'm going to be sitting in a stock that is a little over 5% below the strike price that I sold. Okay. I need to think about that very, very, very carefully and decide if that's something that is going to create some problems. Is that going to create stress for example, that might keep me up at night. Um, if our friend Carl is here, I like the way that he talks about the sleep test. And if your investments are keeping you up at night, then you probably need to modify your rules. This is why I only sold one contract on uh, uh, on this particular trade with an account value of a little over $300,000. That means that this is actually a very conservative position. Again, this is simplified math. But here's 301,000. Actually, I need to start with the position size. So this is $4,600. Hello, Carl. Glad you're here. All right. So start with the obligation that I have to deal with. $4,600 divided by the size of my account. That means that this trade, this position is a little over 1.5% of the total size of the account. That's a very conservative number. Again, if you're a subscriber, you're reading my posts, you know that I make few recommendations necessarily. I'm posting my trades so you can follow them and decide if you want to place the same thing or if you want to adjust to them. But one thing I do recommend is being very conservative about your position sizes. And under most conditions, I usually recommend somewhere between 3 to 5% of the value of your account. That means that in practical terms, if I were going up to 5% of this $300,000 account, woo, sorry, I did the math wrong. This is why sometimes I need to be careful about talking and doing math at the same time. 301. There we go. This is 5% of $301,000. What this means is that I could, if I were willing to go that big, I could allocate up to $15,000 of my account to a single trade. That's still pretty conservative if you think about that, because that would still allow me to take up to possibly 20 positions at the same time. So that's useful from a diversification standpoint. It's also pretty conservative from a money management standpoint. 5% right now is actually not something that I think personally that I'm willing to do. The market is again very extended. We're still looking at there's plenty of uncertainties in the market, and so for the last few years I've been taking a much more conservative approach. I've shortened my position sizes to 2 to 3% as opposed to 3 to 5%. And Gib, you've got a great question, and I'll answer that in just a moment. So now I'm 2 to 3%, as we could see before from this account. This is actually even lower than that. So 4,600 divided by 301. I'm at 1.5%. This is the most, in my mind anyway, the most important question about how to make these trades manageable. It doesn't mean that you turn a blind eye when the stock has dropped below the strike price that you sold and that you're taking an assignment on, but it does make it a little bit easier to deal with because it's a much smaller portion of your account. You're not looking at a major hit relative to the size of the account on any one single trade. Yeah, it's BMY has been picking up some momentum here just since we started talking about it. So I'm still going with the $2.50 down number just to be conservative. Gibbs' question is, do you have an okay, I was wrong, I need to get out number? I don't have a number for that, Gib. It's really about going back to the fundamental analysis. The things that led me to place the trade in the first place. Are those fundamental strengths still in place, or are there signs that there is a very material deterioration of fundamentals. And this isn't just about the metrics, because sometimes things like net income, even free cash flow, can be fluid, but not necessarily for structural reasons. In other words, not because of problems with the business. Sometimes those fluctuations are just the a symptom of real market conditions. If the fundamental strengths of the company are still in place, and I can identify things like, if I can delineate between a deterioration of financial results as being structural rather than maybe cyclical or macroeconomic influenced. If they are if I am looking at structural changes, then that's where I feel like I need to be willing to say, okay, it's time to move on, time to get out. That doesn't happen very often. It has in a few cases. There has been one very, very painful case where I had to take a much larger loss because I honestly did not pay attention to those signs when I should have. Um, but those have been the exception, not the rule. And so you do need to try to think about what that looks like for you. Some people in our group are going to have an absolute. They're going to go ahead and say, I'm going to give this a number rather than have this be a little bit more subjective the way that I'm talking about. Maybe that number is 20%. If the stock has dropped 20% below the level that I was assigned at, I'm done. I think that's fine. Again, this becomes about what allows you to be able to manage your system successfully more than anything else. And if that's what it takes, then that's what it should be. I hope that helps. Walgreens. Walgreens is an interesting case. This is one that was recently taken private. And so, yes, I guess I should say that there are two. This is one I did not foresee them being taken private, being delisted. This is not the stock. This is something different altogether. But this is a stock that I was assigned. I bought this stock at around $50, and it has since been delisted. So, yeah, I guess I should modify that, and I should say there are two examples. Walgreens, though, the one difference between that and the other really, really bad example was the previous traded company called Chicago Bridge and Iron. And in that case, I was overloaded on my position and ended up taking a very, very significant loss on that one. That was it caused a material deterioration in the account. That was several years ago. Hard lesson learned. Walgreens big drop is real, but this was a much more conservative position for me. So it's a little, again, the overall impact is not as big, but yes, it still counts. So thanks. Let's be real. That's what happens, and it's one of the things that you do need to be willing to call out. So we are human, and that's why one of the reasons that I do this each week is not only to try to give you idealized numbers and situations, but to be to show practical realities and try to talk about those. This is one of the ways that I tried to hold myself to my own system. So, okay. So let's take a look at Bristol Myers. 4360 right now, so that's interesting. And again, I'm being assigned today, and need to expand the options chain a little bit. And here is the contract that I sold. Good, Gib. It does help. Gives you another way to measure your errors. Yeah. Thank you. That's exactly right. We do need to try to put both failure and success in proper context, right? And the only way we improve is if we take those mistakes, treat them for what they are, and try to figure out what the lessons are from them. So I appreciate that. That's a great comment. Okay. So this is the strike price that I sold, and there's pretty wide difference between the bid and ask price on this. I'm going to guess the reason for that is there's probably not a lot of activity going on with this contract. Well, there's been some. That's interesting. In literal terms, this is really should be nothing more than the difference between the stock's current price and the price that I sold, simply because the option expires today. You'll see this number become, you'll see these numbers compress a lot more as the day comes closer to the close of the trading day. But for now, what this is saying is if I wanted to buy this option back and close the potential obligation, this is another money management strategy. Maybe if the stock is significantly below and you don't believe that it's going to get better, there are people in the Rebel Income community. There are certainly people who are income generators, just like we are, use put selling actively. They don't want to take an assignment on a put option, and that's great. That's not my approach. Again, I'm treating this as an opportunity to buy stocks that I like. But if your method is to try to avoid the assignment, then buying this back is going to be something you would want to do. That means placing a buy to close order rather than a sell to open. That would mean being willing to buy to close at the asking price, which is 305 right now. And if you think about that in real terms, I brought in about 75 cents on this, right? So 305 minus 75 cents means that I would be absorbing a loss right now of $2.30 per share, $230 total since I sold one contract. Again, if we're talking strictly from a money management standpoint, from a trade management standpoint, and about limiting losses, this may be the smart thing to do, especially if you are concerned about the stock's current momentum. If part of your core method is not about taking an assignment, then this should be what you should be doing today. If you buy the option back before the market closes, then you don't have to deal with trade settlement. And what that means is that your capital, the $4,600 that I have in reserve right now, if I were to buy this back right now, and if I took the 305 asking price, there's enough activity in this contract that would probably get filled, maybe not right away, but pretty quickly. That would mean that the obligation is not only removed, but the $4,600 minus 230 comes straight back into the account. So it would be a little under $4,400. That's a loss. That's real. But it also protects from the potential of a much steeper drop. If the stock doesn't stabilize where I think it may be stabilizing, okay, if this line gets broken, then we have a situation where support becomes resistance. And that will probably keep the stock falling even further. So then the question becomes, how much more downside is there beyond that? Well, I'm going to go back here a little bit, and I just want to try to measure where the lowest lows are. Yeah, we've got to go all the way back to more than 10 years to really get significantly below. But let's just look at this over the last year and a half, and we have some additional lows down here, a little bit below 40. So if support here at 43.50 doesn't hold, then next support for this could be, well, maybe here. Maybe about 41. That's not a ton of downside, but if that doesn't hold, we could be looking possibly, this is a multi-year low down here at around, I'm just going to go ahead and call it $39. Okay. So now the question becomes, if I'm willing to take an assignment here at 46 with the stock now a little bit below 43.50, am I willing to, if I'm willing to do that, am I also willing to still hold the stock at 39? That's a steeper decline. That's $9. Now we're starting to talk about a little closer to 20%. Again, there is not a right or a wrong answer. This is subjective. This is individualized to each person. But these are the decisions that have to be made. These are the things that we have to be thinking about. Barry already is in at 47, so he's a little further away. When it moves up, I'll start writing calls. Yeah, and that's kind of the point, right? I don't mind being assigned at 46. I am okay with this for the same reason that Barry is talking about. I do believe in the overall fundamentals, and the value proposition is very nice for Bristol Myers. And those are some core concepts for whether or not I'm going to place these trades. This is a kind of a contrarian approach, because we are working in stocks that are in clear downward trends, right? And a lot of growth-focused investors are going to look at these and they're going to say, nope, not going to touch that with a 10-foot pole. It's not until it starts moving up. Well, okay. Contrarians aren't afraid of downward trends. That's why we focus on things like fundamental analysis, on value analysis. And as Barry is saying, this is another reason that I'm willing to do these, is because of the dividend. I don't place trades on stocks that don't pay dividends when it comes to put selling, when it comes to Rebel Income. Every stock you see me write a trade about is going to offer a dividend. Now, they're not all dividends are created equal, and what that means is they're not all going to be as high as some of the others. I don't chase yields, but in the case of Bristol Myers, at the stock's current price, this 62-cent per quarter dividend translates to an annualized yield of a little over 5.5%. That's actually very attractive. This is a very nice passive income component. This is something that gives us the ability to bring in real income, even while just for owning shares. By taking the assignment today as well, just like what Barry is saying, here's the next dividend distribution. The X date is the 3rd of October. So by taking the assignment today, I'll qualify for this dividend, and then the payment date is on the 3rd of November. The idea here is, if I own it on the X dividend date, then you're going to be counted among the people that are going to get it. Okay, those dividends are one of the other reasons that I don't avoid these assignments. These are practical income numbers. I don't have to do anything for them except own the stock. In the meantime, I generated 75 cents of income on the trade just for giving somebody else the ability to force me to buy the stock at 46, which I already said I was willing to do. If I was willing to buy it then at 46, why not now, if I was able to generate some income on it as well? So, Okay, so that's Bristol Myers. Let's take a look here at a couple of the other trades. Last week, sold a put option on Coterra Energy, CTRA. Now, this is a 1 month trade, so this is going to be interesting. We're still 3 weeks from expiration on this, so the evaluation is going to be a little bit different because there's more time. So this isn't just about saying, there's still 3 weeks. I'm okay. This is still going to be an important evaluation. We should be doing this every single day, but we're going to take a look at what that looks like. Sold the $24 strike price, brought in a little over 2.2% here with my 55-cent premium. So this was a very, very nice trade. Coterra is a stock I've used quite a bit over the past couple of years. And if you've been following my trades over that amount of time, this wouldn't have surprised you. The stock's drop over the past few months from the upper 20s down into the mid 20s is interesting. And more recently, one of the things that I liked about this trade when I placed it was this low point at around $23. This was pretty strong support when I placed the trade, which was right about in here. And we can see that since then, the stock came down to 23 and bounced and gave us another pivot low as it's rallying higher, starting to approach the 20-day moving average now, a little bit above 24. Now, again, there is still still 3 weeks to expiration. So there's still some time on this. It still could drop back down to 23, possibly, and I could still take an assignment at expiration. And there's still enough time on this trade that I'm really not comfortable saying for sure whether I'm going to not be assigned or whether I am going to be assigned. It's still completely up in the air. But right now, we do see the stock is above 24. Question is, relative to the 55 cents that I brought in, how does that translate to what the position looks like now? So I'm going to collapse this contract, and this expires in 21 days. And here's my $24 strike price. It was interesting because the asking price is still a little bit above the premium that I brought in on this one. So it hasn't moved enough. I mean, let's face it, if I sold the $24 strike price, it would need to be probably up closer to $25 before we would see a material change relative to the 55 cents I brought in that would impact that in a positive way. So for now, it would cost me more to close this than it would to just let it ride. So I'm going to continue to let it ride, let time decay continue to do its thing for me, and we'll see where this shakes out next week. The stock may be back down around 23. So that, again, will change the metrics. It'll change the math. But that'll be something. For now, I can go ahead and hang on to this and let the stock continue to follow its normal price patterns and let time decay do its thing for me. And that's okay. I'm all right with that. This is a trade. We can see here there's plenty of open interest for this contract. Oops, why does it give me the arrow? That always confuses me. There's more than enough open interest here. If I felt like I needed to do something, I probably could. There's even been a little bit of activity, one contract, woohoo! But that's fine. I can leave this as it is for the time being. All right, so those are the numbers for CTRA. If any of you are in the same trade, you want to compare numbers, maybe you beat me, then that's okay too. Nothing wrong with that. Okay, then the other trade was this week's put sale on Nike. Now I made an adjustment from the trade that I highlighted when I send out my trading alert. I originally said I was going to sell the $70 strike price, and I sold the 69. Doesn't mean I was lying. Means that I send out the trading alert on. All right, Barry, there we go. Points earned. 10-3 expiration, so shorter time period, brought in 63 cents at a 24.50 strike. Okay, so that's still a little bit underwater, but still, I like the fact you sold less time, right? So you get an enhanced compounding ability, and you still were able to bring in 63 cents at that price. By selling a little more time, by selling more time, I was able to go lower at 24. That makes it a little bit more conservative. That's all. That's really the core difference. But I was also selling more time to do that. So you decide which one is more important to you at that point. So good job. I like it. Now, when I highlighted the trade for Nike, 1, 2, 3, 4, stock was right around here. It's in the $71 range. Said that I was going to sell the $70 strike. The next day was Wednesday. So that was right here. The stock was stabilizing a little bit, and but it had gone low enough that I was actually able to sell the $69 strike and get a comparable premium for the time period I was talking about. Now, one caveat that's worth bringing up here for Nike, and some of you may not have placed this trade simply because of this reality. This is coming up on earnings. This expires next Friday, but the earnings report is coming out on Tuesday. So this trade is crossing the earnings report. This is why in the post I tried to highlight that and remind you that if you're not willing to hold a trade across an earnings report, if that is something that makes you more nervous, then you should probably not place the trade. Doesn't always necessarily chase me away. Clearly, it didn't in this case. But that doesn't mean that that you dismiss it outright, right? In some cases, when I see that earnings report come up, a lot of cases, in fact, I'll go ahead and say, well, you know what, I'm just going to wait. Why? Well, one of the reasons why is because volatility for the stock almost always seems to pick up around an earnings report. You start to see larger variations in price than normal during these time periods. And in all honesty, if I'm being brutally honest, some of the bearish momentum here that we're seeing really since the later part of August for this may be a reflection of some of the market's expectations about what this next report may hold. Now, whether or not those are real or not, that's a different question. We won't know until Tuesday. But by placing this trade and being willing and saying that I'm going to go ahead and hold this all the way through until next Friday, it does mean that I am tacitly accepting that additional risk. The trade-off for being willing to accept that increase in volatility is that price volatility translates to implied volatility for options. As sellers, that means that premiums become inflated. It's one of the reasons why, well, that's really the primary reason, I should say, that I was able to generate a little over 3% on this trade for a 9-day duration. This is out of the ordinary. This is unusual and not something that I would expect. It is a very real reflection of the fact that this trade crosses that earnings report. Now, again, you may not want to accept this, and that is totally fine. If you did not place this trade on for those reasons, I totally get it. Depending on the stock, depending on the circumstance, I don't always necessarily dismiss that. And I'm not so sure that I agree with the market's what I think is probably an overall negative perception of Nike. And so I thought this is something that looked like an attractive trade as a result. I thought on balance, this was reasonable. It also gave me the ability to work one strike price below the strike price that I highlighted when I published the trade on Tuesday. When I went to place a trade on Wednesday, there's always a 1-day lag for me between when I highlight the trade and when you see me place it. When I log it in my track record, I don't ever place these trades for a full 24 hours after I place after I publish the trade alert. So those are the reasons I was able to generate so much income on a 9-day trade. And I could go ahead and try to annualize that. And boy, that would look really, really impressive here. But the truth is that I'm accepting that volatility. I'm accepting a little bit more risk here. And the stock is just a little bit below that level now. Not a ton, so not so much that I'm really too concerned about it. But even just a couple of days into the trade, this is enough to make evaluation worthwhile, especially since we're still 7 days to expiration. So 68.87.86. Now we're 14 cents below the $69 strike price that I sold. And so we need to close this one. And let's go to 7 days out. And remember, here's the premium I brought in, $2.23. Here's my $69 strike. Cost me $3 a week ahead of expiration if I had decided that this was too much risk for me and I wanted to close this trade. Again, I only sold one contract here, but my capital requirement is quite a bit larger than the one that we were talking about for Bristol Myers, right? 69 times 100 is $6,900 is my capital reserve requirement. And if I were to buy this back today, again, if we're talking in strict money management terms, if maybe I just decided maybe this is too much risk for me, maybe I'm not as brave as I thought I was on Wednesday, for example. Sometimes that happens. I'm not going to say that it doesn't. Subtract $3 from the $2.23 I brought in, and I would be looking at a 77-cent per share loss. $77 total on the contract. Again, this is not so far below the strike, my $69 strike, that I'm seriously afraid of it. But if I didn't want to accept the possibility, the likelihood of continued volatility, not only leading up to Tuesday, but also if we look at the stock, historically around these earnings reports. Okay, well, here is a really big positive bounce, but also some really outsized moves in the few days afterwards, right? here, we see a little bit of upward momentum immediately following, but then a really big overnight gap afterwards that pushed the stock down into these very low levels in the low 50s around this report. Here's this one. Sorry, these are ugly. Not quite as much, but it did decline. So we're talking about a stock that we have seen it show some volatility, not only leading up to earnings, but also, look at this. This is before the earnings report, declining with a sizable gap. These are real movements. And that's ahead of the earnings report. So it doesn't mean that what's happening here is going to stay bearish, but it does mean that some volatility here can happen, and may not necessarily be out of the norm. The stock could gap, and I'm pulling a number out of the air here, and maybe after the earnings report, maybe it opens down here, somewhere in this neighborhood. I don't know. If that scares you, if that's something that makes you feel really, really nervous, and you place this trade on Tuesday when I send it out, then maybe, just maybe, this doesn't look so bad. Maybe taking this at face value and cutting your losses and moving on makes sense. And if it does, you're not going to hear any criticism from me. I'm going to let this play out. Again, I don't avoid these assignments because I like the stock at 69 already. I'm not convinced that there's going to be information in the earnings report that is going to. There may be some numbers that aren't as good as they've been. I'm going to acknowledge that, but I don't think that what we're going to see is going to be so severe as to represent the kind of fundamental shift in my view of Nike that would require me just to say, cut bait and move on. Not for the way that I approach these trades. And again, the dividend on this, this is another dividend paying stock that, sorry, dividend is not showing here. Let me go over here. It's not as fat as Bristol Myers. It's 2.3%. It's still useful. So, okay, Carl. Any stock you place a trade on, you should be happy to have it in your portfolio because it meets your standards for your long-term portfolio. Absolutely, and Carl. You're absolutely you're summing up my approach because I absolutely agree with that. Jay, maybe a straddle for Nike. And you could do that. Straddle trade. Traditional straddle is a long straddle, meaning you buy both a call and a put option at the same strike price ahead of some event that you expect to see, where you would expect to see an increase in price volatility for the stock. You don't really care in that case whether it moves higher or lower, you just want to see it move. The idea here is that you're taking both sides of the market. You're paying a little bit more than you would for just one side because you're buying both the call and the put at the same time. And once the stock makes the move you want, you simply sell the losing leg, and then you try to ride the winning one for as long as you can. Sometimes the move will be enough that it makes the loss on the losing side of the leg completely irrelevant. Again, you could certainly do that. I personally I equate straddles with just any other strategy where you're buying options. I just don't think you're going to get a really high probability of success with those. You do need some kind of clear catalyst for price to increase the stock's price volatility. Earnings is an obvious one that you can leverage, and sometimes you are going to be able to do really, really well with those. So you can experiment with them if you're going to place those trades. I would recommend doing it putting it in a different bucket than what you're doing with your income generating trades. Maybe it's a maybe it's a bucket you call speculative trades. I don't know, something like that. Maybe the casino trades. I'm throwing out numbers, throwing out my own ideas. Okay, those are pretty much the trades that we have on deck right now, and we are at time. So I apologize we weren't able to get to anything that you may be looking at, but I appreciate your your participation and comments. Those are definitely helpful. And as always, Jay, thank you very, very, very much for being here today. I appreciate all of you for your attendance. And again, please feel free to share this with people that you know that you think might benefit from what we're talking about and learning about how to look at the market from the Rebel Income lens. Hope everybody has a wonderful weekend. If anything comes up between now and next Friday, please do let me know. Send me an email, rebelincomesystem@gmail.com. Reach out on Substack or on Discord, and we'll talk again next time. Thanks, everybody.